Welcome to Corporate Governance at LSE. My name is Tom Kirchmaier and I have with me here Josef Schuster from IPOX. Schuster from Chicago, also alumni of the LSE. Welcome back to the LSE, Josef.
Thank you for having me.
What does IPOX do?
So what we do at IPOX, we design financial products related to global IPOs and spin-offs. So we have come up with a set of indexes called the IPOX indexes, which are really asset allocation focused tool to provide asset allocation focused exposure to IPO and spin-off performance in the aftermarket. Around $2 billion tied to various of our indexes. This index is also set to trade as futures contracts on the Chicago Mercantile Exchange starting March 7th.
That's great. Congratulations to that. So we are here very interested in globalization and access to capital, which is obviously a big driver for economic growth. Why are IPOs so important in that mechanism?
IPOs are quite interesting. Obviously, the going public event offers companies the opportunity. Companies receive cash and then do something with this cash. Sometimes this investing of cash after the IPO leads to a lot of innovation, like in biotechs, like in energy, exploration and so forth. From a market point of view, you obviously have only few companies driving the performance of many IPOs, and IPOX really provides a solution to investing in that space.
So it pushes capital into the global space. And so is this product just the US based or is it global? I always talk about global.
We started with the US indexes called the IPOX US indexes, and then obviously we focus at IPOX very much on the global level. So we look at IPOs and spin-offs in Hong Kong, in mainland China, obviously in Europe, in the Nordic region in Europe, on a global basis in Latin America, and of course the core business is US IPOs. This is the lion's share of our business right now.
Simply because there are most IPOs, I guess, in the global world.
Obviously, historically, the US has been very, very important in terms of driving innovation and growth, and the IPO event obviously is very important for US companies, for venture capital, for private equity firms. On average, in the US, around $400 billion of market cap has been created through IPO and spin-off activity annually. So there's a lot of actions there, a lot of size coming, a lot of innovation being fostered, unemployment being created. So very important from a global perspective.
So these are mainly US companies that then list in the US, or are these the companies from all over the world that kind of come to
Some companies, obviously, they are from China, they go public in the US. What we saw actually recently is obviously a rise of the European IPO market, much due to the change in equity culture in Europe on the continent, as well as in the United Kingdom, whereby obviously this going public, selling your company on the stock market has become much more popular because obviously it can result in a lot of advantages for companies to be public.
So this is kind of interesting for us. You mentioned the change in the equity culture. The American model or the Anglo-American model is kind of spreading around the world into Europe, into Asia, providing access to capital, which is great. But I suspect not all IPOs go well. Do we have a feeling for what's the fraction of IPOs that tank after being listed?
So there's obviously, there are a lot of empirical patterns associated with IPO performances, what we had studied at the LSE for a long time in my academic work here. Obviously, first they're underpriced and then they trade differently over the short and on the long run. In the long run, what we define in this first 4 years of trading when the going public effect is very strong and really kicks in. Typically 15 to 20% of the companies on an equally weighted basis would do well, but then obviously 80% would underperform. In terms of median performance, when it takes a median out of a sample of 2,200 IPOs in the US, for example, the median return is 40% down after 4 years of trading. However, the average is around 10% up. And really what we do at IPOX is we try and we find an asset allocation focused solution to capture the performance of these better IPOs. If you want, the Facebooks, the Googles, the CME groups, the Prudential Financials of the world, versus the many Krispy Kreme donuts of the world, which eventually will have underperformed after a long period of time.
So it's really driven just by a few exceptional stars, just the top 5, 10% or so. Do we know actually what the percentage of firms is that outperform and drive the entire market?
There will be around 15% on an equally basis of companies which eventually will have done substantially well in the aftermarket. Obviously, many IPOs will have eventually underperformed. That's what we only know ex-post, that these companies would have underperformed.
And ex-post, the companies that underperform, do they get typically taken over? Do they exit the market again?
They could go bankrupt. They could be taken over by larger companies. They could just trade along forever in the aftermarket as well.
Mm-hmm. So is this just a US phenomenon that everything is driven by this few stars, the top 15%, or is it a global phenomenon?
So this is a phenomenon which is particularly patent to US IPOs, European IPOs, and developed Asia-Pacific IPOs. We don't see this evidence yet from companies, for example, trading in the mainland Chinese IPO market. The dynamics are slightly different.
They all succeed, is it? Or?
They all, well, I mean, the dynamics are different. Yeah. There's obviously a lot of support for these companies from a government perspective, and which skews the returns of respective companies.
And probably also the capital market is much younger in a way, and so we will have to wait and see how this all plays out.
Yeah, again, like what I want to say is this kind of phenomenon really pertains to very developed markets with a relatively strong long-run equity market.
Do we know a little bit more about what constitutes a star, like the top 15%? Are there special ownership patterns, control rights, or is it just kind of technology and luck?
Obviously some early stage technology companies can drive the performance, but what we really find is that the underperformers are really small IPOs and micro-cap IPOs, the larger deals which have actually a long-run history, which have an earnings record, which have sales, and which are not like underpriced too much at the openings. They typically actually do perform quite well in the aftermarket. But it's very hard to say whether, we don't want to distinguish between venture capital backed, private equity backed. At IPOX really pools these companies together as a group of equity, if you want.
Do we know how much typically is floated? Is it like 10%, 15%, or is it a much bigger stake?
The average float in the US right now and in Europe is around 27%. It's obviously companies in high tech, like a Twitter, like a Groupon, so they typically float very little on the market. This has to do with the fact that they obviously want to support a respective high valuation for as long as they can get in the aftermarket.
But obviously also you have an owner with a very strong interest, because he then carries whatever, 70% plus, or the group of initial owners.
That's correct. Obviously, if you look at venture capital-backed IPOs, even some private equity-backed IPOs, the ownership of a certain group, of a venture influential group, would be quite high. And you see then subsequently in this first 4 years or 5 years in the aftermarket, these owners kind of reducing the stake in the companies. And this stake then is being bought by other private equity firms, by hedge funds and so forth.
So it's not typically floated out, it's more like it goes to another institutional investor.
It's being floated as secondary offerings in the aftermarket, but obviously secondary offerings are then only being taken up by the market if the respective firm is really successful in its stock price. Otherwise, it's very hard, obviously, to sell at a good valuation if the underlying company is on a downward drift, especially if sales are not growing, if price earnings ratios and price to sales ratios cannot be maintained.
Josef, we're almost out of time. One last question. What's the outlook for the future in the IPO market?
The IPO market goes through cycles. Right now it's kind of slow because obviously it's linked to volatility in the stock market. Overall, if you're a capitalist, IPO activity will always be there, and spin-off activity. And so there's a solution IPOX which offers. It's an indexing solution to that space, whereby investors can capture the alpha of respective company and avoid underperforming companies.
Many thanks, Josef, for coming in all the way from Chicago, and many thanks to our viewers for watching us today.